What's up everyone and welcome back to the channel. My name's Jordan and today we're going to be talking about how to calculate the implied move of a stock. When a company has a big event coming up, for example like an earnings event, we as investors and traders are concerned about how much the stock is likely to move after that event. And what we can do as investors and traders is use the options market to calculate how big this move is expected to be. And this is what we call the implied move. Now, why might we actually care about an implied move? Well, think about this. Imagine Apple was implied to move 20% after their earnings event tomorrow. If you were a hedge fund manager or a mutual fund manager and had a lot of exposure to Apple, wouldn't you want to consider hedging your risk? And that is how mutual funds and hedge funds use this indicator. Because if a company is expected to move a lot after an event, they might not want all that exposure. So they want to hedge their risk. They either reduce their position size or go into the options market and buy some puts or buy some calls if they're short the stock. As speculators and option traders, we might want to be taking a view on the expected move versus what our models say. So if our models say that this stock should only move 10% tomorrow, but the implied move is 20%, then we can make a trade based on that information. Like I said, we use the options market to see what the expected move is of the stock. Now, of course, you can have your own models to have a prediction on how much a stock should move. For example, Netflix is more likely to move more on earnings than Coca-Cola. And this is obviously due to the growth of Netflix and the volatility of their earnings versus Coca-Cola, a very stable and steady, mature company. So in this video, we're going to look at how to calculate the implied move. And there are actually 4 steps in calculating the implied move. And I'm going to go over each one step by step in detail. So I hope you guys enjoy this video. If you do, hit that like button. Also, if you're not already subscribed, hit the subscribe button and I'll see you guys in the video. I'm going to use Thinkorswim here to give you guys a visual demonstration. And I'm also going to be using CarMax, which is KMX, for the examples. And this is because they have earnings tomorrow. And I also have a short volatility position on the company. So let's take a look at what the implied volatility is. So here you can see the implied volatility is 43 currently. And this is the 30-day implied volatility. And what happens is this volatility is made up of 2 parts. One part is the event volatility. So what's going to happen during the event. And then the other part is what's going to happen outside of the event. So after the event is gone, right? And that's what we see here. So after earnings, we get this massive vol drop, right? After earnings, volatility gets reduced. And the reason for that is because the event volatility is now taken out of the option prices. The event is over. So now we are just left with the non-event volatility. And for us to calculate the implied move of the stock, we need to figure out what the event volatility is, and then we're going to convert it into the implied move. So there's going to be a little math, but I'm going to go through it step by step, so you guys should have no problem following along. And I think this is going to be very helpful for you in your trading. It helps me all the time. This is my bread and butter, trading earnings volatility. So hopefully you guys can pick up something useful. So there are going to be 3 steps to calculating the implied move, and that is first calculate the non-event volatility, then we're going to calculate the event volatility, and then we're going to convert event volatility into the implied move number that we're looking for. So let's start with number 1 and calculate the non-event volatility. So the way we do this is we find 2 option chains that are expiring after the earnings date. So for example, KMX is having their earnings tomorrow, September 24th. So we can choose any 2 of these option chains. But for this example, we're going to choose the monthlies. So we're going to choose the October and the November. Once we choose these 2 option chains, we can just use these numbers right here, what the implied vol is for these 2 expirations. We can also use the at the money implied volatility, so it would be 43 and 35, but we're going to just use the whole option chain volatility, which is the number right over here. In Interactive Brokers or Questrade, they all have this same number right here on the option chain. So you can just use that for whichever broker you're using. So we're going to be using 45 and we're going to round that one up to 37. Also, something you need is the days till expiration. So we have 25 days until expiration here and we have 53 days until expiration for November. Now that we have that, we're going to move over to Excel and I'm going to do this in Excel so that it's applicable to everybody. I usually program in R, but like I said, this is definitely more applicable to people. So we're gonna have expiration month 1 and month 2, implied volatility. Month 1, which was October, had implied volatility of 45. And month 2 had an implied volatility of 37. Days to expiration was 25 and 53. Just double check. That is correct. So now we have to calculate the non-event volatility. The formula for this is going to be the square root month 2, which is the back month, to the power of 2. And keep in mind, guys, that the implied volatility is in percentage here, so it's 0.37 instead of 37. Times the days till expiration, so 53, minus first month volatility squared times the days till expiration. And we're going to put that in parentheses. And we're going to divide that number. Oh, sorry. You have to put another bracket here because we're square rooting the whole formula. Divided by the difference in days. So this is going to be 53 here. It's going to be 53 divided by 53 minus 25. All right, and we'll just close that out. And so this is our non-event volatility, 27.9%. So now we calculate our event volatility. The event volatility is what we're basically doing is calculating the total volatility and then subtracting the non-event volatility from that. So what we're trying to do here is there are going to be 24 days of regular volatility and 1 day of the event volatility, right? So what we're going to basically be doing here is subtracting 24 days of non-event volatility from our total volatility, and that should give us the event volatility. So the formula here is it's going to be square root, and inside that we're going to have the implied volatility squared times the days until expiration minus the non-event volatility times the days until expiration minus 1, right? Because we're taking 24 days of regular volatility out of the total volatility. Sorry, it's going to be the non-event volatility squared. I forgot to put a square there. Times. And we're going to close that up. And here we have our event volatility. So this is 178% for the event volatility. And now that we have this number, we can go ahead and calculate what the implied move is. Implied move is going to be square root however many days in a calendar year, because we use calendar days for our days to expiration. If we use business days to days to expiration, if we use business days and days to expiration, we would use business days in our implied move. But because we use calendar days, we're also going to be using calendar days in the implied move number. Remember, guys, to keep it consistent when you're doing these. So we're doing square root 1 divided by 365 because we're doing 1 day. We want to know what the implied move is going to be for 1 day times the event volatility times the event volatility times square root 2 divided by pi. And the reason why we are dividing it by pi is because of the normal distribution formula, and that is outside the scope of this tutorial. But if you guys want to do your own research, feel free. So we hit that, we hit enter, and we get an error. Excellent. Sorry guys, I forgot to put a parentheses around pi because it is a function. So you have to call pi 2 brackets and then close it out. And when we hit that, we now get the move of 0.0745%. So that's how much percent it's supposed to move. And if we look at CarMax's price, which is 86.90, then the implied dollar move is simply going to be 0.0745 times 86.90, which is the price of the stock. And there you have it. $6.47 is what the implied move is of CarMax tomorrow. And just to show you guys what this really means when you're trading, what this $6.47, what does it mean to have an implied move of $6.47? Well, if you come over here and let's say we sell the at the money straddle. So this is what our short straddle looks like when we put on the position right before the close. And now we know that's going to have a $6.47 move. What that means is it tells us where our break evens are. So if we go so right now the implied volatility for the at the money is 43, but we're going to say it goes down to our non-event volatility tomorrow, which is 27%. So if we change this number now, so that we're roughly 27%, you'll see that our break even roughly $6.40, which I think is what we said, right? $6.50. So if we go 87 plus $6.50, that leaves us with $93.50. And as you can see, we're basically almost spot on. We're 30 cents off. And so that is roughly what the implied move tells you, where your break even is going to be after the day of the earnings event. So as you guys know, earnings trading is my bread and butter, and I don't have time to be doing Excel spreadsheets all the time and trying to figure out, where is there an edge. So what I did was I built an application that helps me do this a lot quicker. And if you guys want to give it a shot yourself, feel free to reach out to me and we can talk. So if we look at CarMax today, you will see that the implied earnings move, we have it right here. It's easy to look at. You can compare it, what the average move usually is, how much CarMax usually moves, and how much it jumps, how much it moves during the day. And so it's very easy for me to say, okay, well, is this implied move expensive? Is this implied move cheap? Here's a little window panel right here that explains the event volatility and the non-event volatility. The green line is our regular volatility, right? That's our total volatility. It's the number we see here on the screen, right? It's what the total volatility is. And then we have the red line, which is the non-event volatility. And so it's very easy to, instead of having to do Excel spreadsheets. Like I said, guys, I am short CarMax volatility, so wish me luck. I'm short the 87 straddle October expiration for $7.60. If it comes through, I'm always happy to make a couple gains through the market. Anyways, guys, that'll do it for me. If you guys like the video, give it a thumbs up. Reach out to me in the comment box, and don't forget to subscribe. Cheers.